Hey everyone, welcome back to Corporate Decoder. Today we're diving into the latest report from DIRTT Environmental Solutions, and let me tell you, after reading this, I'm seriously considering redoing my entire office space. Maybe I'll ask them to pay for it. We're going to discuss their recent performance and what it might mean. So this report is for an event that happened on February 26, 2025. It's called a Form 8K, which is basically a quick update companies give to investors about important stuff that's just happened. Think of it as an FYI for the business world. The company we're looking at is DIRTT Environmental Solutions. They are based out of Canada. Okay, so let's get to the meat of the report financial results. DIRTT released a press release about their financial results for the quarter and year that ended in December of 2024. We are going to take a look at that now. The report includes a copy of the press release, which includes a recap of their financials. Let's dive into the numbers. First, revenue, which is basically how much money the company brought in from sales, decreased 10% to about $132 million. That's a pretty significant drop, which might worry some investors. It means they sold less stuff or charged less for it. On a brighter note, their gross profit margin actually increased to about 31%. Gross profit margin basically means how much profit they made on each product after taking into account the direct costs of making that product. Even with a better profit margin, DIRTT still had a net loss of $1.2 million. Net loss is what's left over after you subtract all costs from all revenue, meaning this is their true profit or loss. Losing money isn't a good sign. It means they are spending more than they are earning. Now, a point of good news, their adjusted EBITDA increased to $6.8 million. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a way to look at a company's profitability before all those extra costs get factored in. Adjusted EBITDA just means the company has tweaked it a bit to take out some unusual or one-time expenses. Another bright point, their backlog increased 6% to $163.3 million. Backlog is the amount of orders they have that haven't been completed yet, so more backlog is usually a good sign. Let's get to the CEO's comments. This is where we get some context or some spin depending on how you look at it. The CEO is Todd Littek. Let's see what he said. According to Todd, these results show steady execution in key areas. He notes the revenue decrease was anticipated due to project delays. He also mentions they are navigating a challenging macroeconomic environment. This is corporate speak for the economy is tough right now. He ends by saying that they are focused on their long-term strategy for growth and profitability. All good news if you are an investor. Now let's take a step back and look at the bigger picture here. DIRTT is in the business of creating customizable interior spaces. They are trying to be faster and greener than traditional construction. They want to shake up the construction industry with tech and sustainability. The report was signed by Fariha Khan, the Chief Financial Officer. So let's break down what all this means for DIRTT. On the one hand, the company is facing challenges. Revenue is down and they are still losing money overall. But on the other hand, their profit margins are improving. They're doing a better job of managing costs and their backlog is growing. It's a mixed bag. One thing to consider is the overall economic climate. The CEO mentioned the challenging macroeconomic environment. Interest rates are higher, construction projects are being delayed, and businesses are being cautious about spending money. Now, for my take, I think DIRTT has potential, but they need to execute their long-term strategy for growth better. Their innovative approach to interior construction could really pay off if they can continue to improve their efficiency. The increasing backlog shows there is demand for their products. If the economy improves, DIRTT could be in a good spot to grow. However, the losses and revenue declines are very concerning, and the company needs to stabilize its financials. The adjusted EBITDA is certainly a point of optimism, but EBITDA does not paint a full picture of real cash flow. Ultimately, I think DIRTT is a company to watch. They have a good concept, but they need to prove they can make money. Thanks for watching. If you found this breakdown helpful, please like the video, leave a comment, and subscribe for more deep dives into the world of corporate filings.